In this video, you're going to learn about some of the most common investment banking interview questions on the topic of weighted average cost of capital, cost of equity, and beta. Probably the most common question you can get on this topic is just what is the formula for WACC and what is the formula for cost of equity? So for WACC, you actually see the formula right here. Basically, the idea here is that you take each part of the company's capital structure, equity, debt, and preferred stock, you multiply by the cost of equity, cost of debt, or cost of preferred stock, and then you add them all together. The only tricky part is to remember that for debt, you also have to multiply by 1 minus the tax rate because the interest paid on debt is tax deductible. So this one is fairly simple, and intuitively I think it makes a lot of sense. You're just summing up the costs of each part of the company's capital structure. For the cost of equity, remember that the concept here is that we want to take the risk-free rates, then add the equity risk premium, and then multiply by levered beta, which is the adjustment factor. The reason we're doing this is because we want to look at how much an investor could earn risk-free in government bonds, then add the additional return over that he could earn by investing in equity, and then we have to adjust that number for company-specific factors and capital structure-specific factors with levered beta right here. A related question on that topic is what do you use for the risk-free rate? What do you use for the equity risk premium? We've been over this as well. For the risk-free rate, you would typically pull this data from the US government, US Treasury website. If you're working with a non-US company, if you're working in an international or foreign market, then you would pull this data based on the interest rates on long-term government bonds in that country instead. For the equity risk premium, this varies by bank and group, but usually you look at a publication like Ibbotson's, or you use whatever standard your bank or group uses for these types of companies and you go with that. Usually the equity risk premium is in the 3% to 10% range depending on the source that you're using. Another question you can get here is in the cost of equity formula, is there anything additional you could add? So we know that it's the risk-free rates plus equity risk premium times levered beta, but is there anything else that you could add to this formula? And the answer is yes. Two common additions you can make are the size premium and then the industry risk premium. So the size premium, all else being equal, smaller companies are going to be more risky than larger companies and they'll have a higher expected rate of return. So you might add a small size premium to this formula to take that into account. You could also add an industry risk premium as well, because all else being equal, industries like technology or pharmaceuticals or biotech are going to be a lot more risky than something like manufacturing, let's say. So you could also add an industry risk premium to this formula. What you do here and how you treat these depends a lot on your bank and group. Not everyone actually adds these in. Some people argue that they're actually already taken into account with the levered beta calculation right here, while other groups, other bankers argue that you should actually add them. So this one is subjective and there's no clear-cut answer. I'm just bringing this up because it could come up and you do sometimes see these additions with a real DCF and WACC analysis. Now another question here is about the relationship between levered beta and unlevered beta, how that works, and why we actually need to calculate both of these. So the reason we need to calculate unlevered beta here, and the reason why we need to unlever it and then relever it, is because we want to look at the risk associated with the companies on a capital structure neutral basis. So ignoring debt, how risky are these companies, taking into account everything except for debt? That's why we look at unlevered beta here. We need to relever it because the company we're analyzing, Apple in this case, may actually have debt. It might have a capital structure that's extremely different from the companies analyzed up here. Because with unlevered beta, we're looking at everything on a capital structure neutral basis. We need to relever it because we want to take that standardized number and then apply it to our own company. So we need to relever it below in this levered beta calculation. If you get asked about the relationship between levered beta and unlevered beta, I think the most intuitive way to think about it is what we went through before, that levered beta equals unlevered beta plus unlevered beta times 1 minus the tax rate times the debt to equity ratio. And the idea here is we take the company's risk without debt and then we add in the additional risk we incur by having debt in this case. We multiply by the tax rate because taxes will reduce the risk of debt because we end up paying less in taxes as a result of that interest. We multiply by the debt to equity ratio because all else being equal, if we raise an amount of debt equal to our market cap, our equity value, then the risk of this company will double. A related question you can get here is in terms of beta, are there certain industries that are going to have a higher or lower average beta? And the answer is yes. We touched on this before, but in general, riskier industries that are more volatile, so things like technology, biotech, pharmaceuticals, will tend to have higher beta than something like consumer companies, retail companies, manufacturing companies. Anything that is fairly stable and reasonably predictable like that is going to tend to have lower betas in general than something that's more volatile. So yes, there are certain industries that are more volatile and will therefore have higher betas in general. Another question you get here is on the cost of equity, and specifically whether the cost of equity should be higher for a larger or smaller company here. So this one's actually a bit of a trick question because it depends on the company's capital structure. Now, if the company has no debt whatsoever, as is the case for Apple here, actually a higher equity value, so let's change this to 250 billion, cost of equity will not change because our levered beta will not change at all. This calculation becomes more interesting if we have debt. So let's say that we have 100 billion worth of debt on our balance sheets. Cost of equity here has gone up because of this debt. So the question is, what happens when equity value here also goes up? So let's say equity value goes up to 300 billion. In this case, cost of equity goes down. The reason why it goes down is because with a higher equity value, less risk is imposed by raising 100 billion worth of debt and having it on our balance sheet. So all else being equal, assuming that debt stays the same and that we have debt, a higher equity value for a company means that levered beta will be lower and that as a result, cost of equity will also fall. Now, if it's the reverse, if the company is smaller, then going back to 250 billion here, our levered beta goes up, and so our cost of equity here goes up. Now, on that note, you could also get a question on the relationship between debt and cost of equity here. So once again, all else being equal, assuming that we're holding equity value here constant, then if we have more debt, our levered beta will be higher because debt imposes additional risk, and so cost of equity here will go up. So all else being equal, with more debt on our balance sheet, our cost of equity is higher. You could also get some questions on the relationship between debt and weighted average cost of capital. And this one is a little bit more tricky and more subtle. So let's go to our weighted average cost of capital calculation right here. Now we have 150 billion of debt, 250 billion worth of equity, and we want to answer the question of what happens when debt here goes up. So if we have 200 billion worth of debt instead, what happens to our WACC value? We see that WACC here has gone from 12.3% down to 12.27%. So all else being equal, additional debt will lower our WACC number. The reason why this happens is because in the WACC calculation right here, our cost of debt is 9% here, whereas our cost of equity is significantly higher. It's around 17% in this calculation. Cost of debt is lower than cost of equity, and so additional debt will raise the proportion of debt in our capital structure and will therefore reduce our weighted average cost of capital. We're also multiplying by 1 minus the tax rate, which means that all else being equal, the cost of debt will almost always be lower in this formula than the cost of equity. And that's actually another common interview question. Which is higher, the cost of debt or the cost of equity? Technically, it could go either way, but 99% of the time, cost of debt is lower because the interest rate on debt is usually lower than the cost of equity, and also because we're multiplying by 1 minus the tax rate here. Now, I mentioned before just now that when we have additional debt, that all else being equal, our cost of equity here will go up, but that our WACC will go down. Now, this is true to a certain point, but there are limits to this calculation. So let's say hypothetically that we had 500 billion worth of debt here. So our cost of equity has gone up to 23.86% here. Our WACC has dropped even further. Well, what would eventually happen here is if we raise debt to a truly high level, then our interest rate on debt might go up to a very, very high percentage. So rather than 9%, let's say hypothetically that we got to 30 or 40% for our interest rate on debt. And in this case, we see that our WACC has actually jumped by a tremendous amount here. It's gone from 12.15% to over double that, to 26%. And this is actually what happens when you raise debt to a certain level. The interest rate on the debt once you get to a certain point, starts going up by a tremendous amount, and that outweighs the fact that the cost of equity, all else being equal, is usually much lower than the cost of debt. And so the relationship between debt and WACC is a U-curve. Usually when you add debt, it reduces WACC, but once you get to a certain point, WACC actually starts going up because past a certain point, the interest rate on debt and the cost of debt start to outweigh the cost of equity in this calculation. Another question on this topic you can get is, how does WACC change depending on whether the company here is bigger or smaller? So is WACC higher for a smaller company or for a larger company? So once again, we're going to make a calculation of our own here. First, I'm going to take debt to 0 to reset WACC to the 12.5% number. So let's say our equity value goes up to 500 billion here. WACC does not change at all in this case because we have no debt. However, let's go back and say we have 100 billion worth of debt and we have 100 billion equity value right here. So let's say our equity value here goes up to 110 billion. In this case, our WACC goes up. And so the reason why WACC goes up slightly here is because the percentage of our company that's taken up by equity now has gone up, and the cost of equity is higher than the cost of debt here. So when we have a higher cost capital structure, then overall our WACC is going to go up here. And so that's the effect of increasing equity value on WACC. Another question you can get on this topic is, what do we use for the discount rate in our DCF analysis? And we have gone over this briefly before in the DCF videos, but essentially what you do here is, if you're looking at unlevered free cash flow and you're trying to get to the enterprise value of the company, as we are right here, then you would use WACC, weighted average cost of capital, because we're looking at everything in the capital structure: equity, debt, preferred stock. Whereas if we're using levered free cash flow, then instead of WACC, we would simply use cost of equity for our discount rate in the DCF analysis. The reason for this is, once again, equity value goes along with levered free cash flow, cost of equity goes along with levered free cash flow and equity value. So if we're just trying to get to equity value, we would use cost of equity for our discount rate rather than WACC. As an example of this, oftentimes when we're valuing financial institutions, we use what's called a dividend discount model, and we try to get to equity value there because enterprise value is sort of a meaningless metric for financial institutions because of their large cash balances. So when we try to get to equity value for companies like that, we're pretty much always using the cost of equity for the discount rate here. So that's a real world example. Whenever we're valuing a financial institution or a bank and we're doing this type of analysis, we would use cost of equity for our discount rate here. Now, on that note, another question you get is, where are dividends factored into the cost of equity here? So you see that nowhere in our calculation have we taken into account dividends. The short answer here is that dividends have already been factored in because they're already included in this levered beta number right here. Remember that beta measures the return of a company relative to the market. So a company's appreciation relative to the market is equal to its stock price appreciation plus dividends. So this beta number is already taken into account dividends. So we don't need to add it in or do anything special here. Our cost of equity number has already included this because the beta number that we're pulling from Google Finance or Bloomberg already includes the effect of dividends. A related question here is, are there any other ways to calculate the cost of equity beyond what we went over here, the risk-free rate plus the equity risk premium times levered beta? Are there any other ways to do it? And the answer is yes. One other way you could do it that's commonly used, again, for financial institutions and other companies that issue dividends on a regular basis is the following. We can say cost of equity equals dividends per share divided by share price plus the growth rate of those dividends. So in this case, we're basing cost of equity on the company's dividends and share price and how quickly those dividends are growing. The problem with this calculation is that it doesn't work for companies that don't issue dividends. We need to have some kind of dividends here, or else this calculation is not going to work at all. But there is one alternate way you could calculate this. This one's unlikely to come up in interviews, but you could get it, and it is more applicable to certain industries such as financial institutions, for example. Another question you could get on this WACC analysis is, how do you figure in convertible debt? So what do you do with convertible debt? How do you count it here? And this one's actually fairly straightforward. If the convertible debt is actually debt, then all that happens here is you count the convertible debt as normal debt in this calculation. If, on the other hand, it's actually convertible into shares and you could actually get dilution from it, then you simply add it to the equity value here. You do not count it as debt, and that's all you do for convertible debt. The only tricky part is that you have to build in a switch in your model to take this into account. In this case, we haven't bothered because Apple has no convertible debt, but that's how you'd figure that into this calculation. And then one final question here is, what do you do for WACC with private companies? So in this case, we've been able to calculate it fairly easily because these are all public companies. Apple is a public company. We can easily get their market value of equity and debt as well. But what do you do when the company is private? Because you can't find beta for that type of company. You don't have a market cap for that kind of company. In that case, we normally look at WACC for comparable public companies. That's probably the easiest approach. So if we're looking at a private company that's very similar to Apple, then we might actually calculate WACC for Apple and then use that for the private company. We could also potentially look at work done by auditors and accountants and see if they have any estimates for WACC. There are some other ways to estimate this number, but what we've done here, known as the capital asset pricing model, is the most common way that you do it in investment banking. So we could look at the work done by auditors and accountants, or we could just look at WACC for comparable public companies. So those are some of the most common questions you can get in investment banking interviews on the topic of WACC, cost of equity, and beta. Hopefully you should have a much better idea of how to answer these types of questions now. Now that we've been through the public company comparables analysis, the precedent transactions, and the DCF and WACC analysis, what we're going to do next is summarize everything we've done in our valuation. So we're going to go back to this valuation summary page, pull in all the data right here, and I'm going to show you how to create a graph that actually summarizes everything visually and makes it easy to present all the information in PowerPoint. So that's what's coming up next.